This is a special report, Big Picture U.S. Stock Market, December 30th, 2022, looking at 2023 and beyond. I do this show at the end of the year. It's kind of a habit and it's good for me. I like to do that and I get to review all of the important longer term charts. And then I do all of the analysis for the coming year. And I share my work with the stock market and other markets. And this time there's going to be a part two to this for our members. So for those of you that are not a member and don't get our videos, you will want to subscribe. And I've had an amazing amount of emails coming to me on people that are saying, well, when are you doing the year-end show? Well, here you are. Coming into 2022, most participants were bullish again. They had seen 12 years of easy money, and the Fed was doing a great job at convincing most investors they were really able to handle anything. They were up for the possibility of inflation getting up a little higher than they wanted to, and they said, of course, they had the tools, and they had analysts very bullish also. So people were very convinced that Fed actions, government stimulus, all of that, and the bullish analysts had them believing that the market really could not go down. And there were so many people that had not even seen bear markets before. Inflation had been running only up to about 1.6% for the last several years, and their target was 2%. And they said that, based on that, it gave them a good reason to stay loose. They didn't exactly use those words, but we saw it happen. And then all of a sudden things started to change. Like 1.6% and 2% isn't that far apart, but for some reason they just wanted to continue to be very easy. And of course, with the pandemic coming, they had a good excuse for that. And 2021 saw the government do insane levels of spending, and that money sloshing around out there really had lifted stocks. Of course, what that does is it creates a tremendous amount of malinvestment. That's money going into places that really shouldn't be because it's like gambling and the valuations get absolutely crazy. And that's what happened. Malinvestment was really rampant. What it looked like really was the insane speculation in crypto, where we saw the Bitcoin get up to 67,000 and NFTs where they were paying stupid millions of dollars for pictures of silly monkeys, and stocks getting up to valuations that was historic. Of course, cars got up tremendously, and there was a shortage because of the chip shortage, which apparently is now solved, and housing prices went ballistic, with many areas up 40-50% in the last couple of years. And then the SPACs, which are essentially entities where they have a blank check given to them by their investors. The money pours in there, and then they don't even know what's going to be bought. And so they were paying huge prices for those. No price was too high in anything. No risk was too big. People were just simply complacent. And the hubris of the Federal Reserve really helped with that a lot. And when inflation started to pick up, of course, we know at the end of 21, the Fed was really in denial. And they would have to admit they were wrong, and they didn't want to do that. And certainly they didn't want to kill the economy. So back was November of 21, they finally decided, Powell came out and said they were retiring the word transitory. At that point, the inflation numbers were moving up enough to scare them, but that didn't stop the stock market, which basically closed at its highs at the end of 2021. The market per an article, investors, strategists, I'm sorry, per a Yahoo article that was recently published, talked about the 12 major brokerage firms and their strategists from those firms. None of them at all were bearish. Every single one of those 12 major strategists in the major firms were all bullish. They were all looking for higher prices for stocks in 2021. In fact, the median target for the S&P 500 coming into 2022 was 48.25, which of course that was ridiculous. The range of the analyst, what they expected was that it would be somewhere between 4,400 and as high as 5,300 on the S&P 500. Then, of course, lots happened. Russia invades Ukraine, oil and gas prices explode to the upside, and that helps with the inflationary surge. Of course, oil and gas prices have since come well below that the pre-invasion prices. But the Fed, they were tightening aggressively with four increases of 0.75%, which we had never seen before, as they were dealing with inflation that was 41-year highs, and the rolling off of their balance sheet, which started out at 47.5 billion. Trillion, sorry, I'm sorry, they were rolling off at 47.5 billion and then increased that to 95 billion per month. That was coming from a level of around 9 trillion, and they are scheduled based on this to continue to roll their balance sheet off to get it to a level just below only 8 trillion in the coming year. So there's a lot of tightening yet to come, or certainly not being as loose as people hope. And as the market fell last year, analysts, they lowered their targets. In September, their median target was lowered from that 48.25 in the S&Ps down to 4,300, and by October they were lowering it to 4,000, which of course was still way above what our targets were. This describes the bullish trance investors were in, and in the trap again that the Federal Reserve had set. Of course, our analysis showed something very different, and that's coming up later in the show. Right now, what I want you to see is the momentum tracker and the results for the coming year, and I think that this is a good way to look at it. For the year, the stock market indexes, of course, have done quite poorly, and really broadly mixed as far as the amount of losses. Let's just review this quickly and look at what the worst and what the best of the major indexes were. The QQQ, or the NASDAQ, was the worst, down about 34% on the year here as we record this with about just a day to go. And that was a year that was marked with giant losses in the high techs, the FANG stocks, really come down very significantly. Let's take a look as we look at our at a unique app here, the askSlim Momentum Tracker, as we look at the QQQ. And you can see here that what we have is still coming out of the year here, very negative conditions. Long-term, intermediate, and short-term. This is reflective of our proprietary algorithms, which shows you an overall directional bias that is very bearish. Of course, there will be bounces in there, but then the market is likely to give a lot of ground. This is an investor outlook looking 3 months plus. And really, I like this, especially if you look at our chart in here. And that gives you a good sense for the how the condition of the market has been throughout this year. And you could see these ends and the big arrows or smaller arrows has got only a little negative, and here is it had a rally and then came down. It's been in these negative readings, and very negative, as you can see right over here, as the QQQ, or the NASDAQ, has been extremely weak, that giving up about 34% for the year. The next weakest was the Russell, and we'll just switch over here to IWM, which lost 22% on the year. So we'll go to IWM, and you can see in here, still the conditions are very, very bearish. I put an extra very in there, but that's our 3-month outlook is weak negative conditions suggest failed rallies and lower prices, and that is the condition right now. And while we could get a market rally as we expect in January, it's going to take some work for these longer term readings to get them to change. The first one you'll see would be the short term, which would go to neutral and then to green, and then the directional bias would change. If you look at the chart in here for the year on the IWM, you can see that, well, it's been negative throughout the year, different levels of negative, but has remained very negative. So again, of course, a situation where an index losing significantly, 22% for the year, is quite weak. The SPY now down about 20% on the year, and you can see in here still very bearish conditions in there as we look at this. And I'll show you a little bit later a little better view of some of the stocks. But this is the look at the SPY, and of course we'll look at this chart in here, and the chart does show us, and by the way, this log in here shows you when each of these last directional bias conditions changed in each of these time frames. So that is always helpful also, and you can see the chart in here giving you these negative readings throughout the year, never telling you that it was a time to buy or to edge to the long side, always giving you a negative reading. When I switch this over to the Dow, which only is down 9% on the year, and I've got some more positive things to say about the Dow. We'll look at the DIA at that ETF to get the reading. You can see that this is only slightly bearish right now, and beginning to give some indication of improvement in there. And if I look at the chart of the DIA, you can see in here that it has been, of course, negative throughout this whole year right over here. And right over here, you see that M that gave the beginning of a mixed reading in here. And it's slightly negative right now, as you can see, but we think that will be turning more to the positive side, maybe before any of these other indexes. So that's a look at our very unique market monitor. A momentum tracker, which then does give you a good look at the overall conditions of the market. And you can scan groups in here and stuff like that, and I'll give you another look at that a little bit later. But that's available to all of our premium members, level 1 through level 4. So that's a look at the stock market week all year long, and lots more to say about that. Before we continue with our overview of 2022, let's just do a little legal that we need to take care of. And we want to tell you that everything that we share with you from askSlim.com is for entertainment and educational purposes only, is not to be construed as investment or trading advice. That's whether we do it orally or in videos or however we present our information. You should always be discussing with your own investment advisors before acting. And also, we also want you to make sure you look at your own trading plans or investment plans before you make your trading decisions. Always want to be smart at what we do. For those of you that are brand new to askSlim, there's lots for you to learn. You can go to our website, askSlim.com, and explore there. And make sure you subscribe where you can and share it with other people and follow us. If you're brand new, you might want to get acquainted by becoming a level 1 member. I'll show you what's in there in just a little while. YouTube, subscribe to the channel, and then if you click the notification bell, you will then know when we post videos. Like this video, give it a thumbs up, and on Twitter, follow us at askSlim. And for more information on askSlim.com, Matt can give you that by writing to Matt at askSlim.com. All right, we have a lot more to show you here as we move forward with our overview of 2022. For individual stocks, well, for the tech stocks, it was a brutal year. So many of those companies that were just so incredibly overbought that investors had so much confidence in that they were the future got creamed. The biggest loser of all of the big tech stocks we've seen just come apart here in this end of 2022 was Tesla. Tesla down over 70% on the year. Meta, which in my opinion, just a horrible decision to change the name and to focus the way they did. They had some sense that their business model was faltering and they needed to change, but that was really bad for them. So Meta down about 65% on the year. PayPal, which got really blown up to the upside as the crypto craze came to them, and also people staying at home and buying things online. So PayPal was really boosted, and that gave up about 64% for the year. A lot of those stocks in the semiconductor category that really were very strong the previous year gave up tremendous amounts this year. AMD about 56%, Nvidia about 52%. Netflix was down 52%, Amazon 51%, Disney 45%, Google about 40%, Microsoft 28%, and Apple about 28%. So those two stocks that I mentioned that in these tech category that were weak, Microsoft and Apple, actually not that weak, only definitely stronger than the Nasdaq, and a little bit weaker than the overall broad market. So that's really the picture of what really weighed on the market, were those stocks giving up huge amounts of their excessive PEs that they had. Of course, the question is, how will they do later? Well, they've got a lot of base building to do before they can do anything that is significant. And that might be years away. The other category of stocks that I think is important to mention are the old industrials, and they have done exceptionally well, a lot of them, as money has moved into what really is a safe haven. The investors no longer want to be in those highly speculative high flyers. They want to be in the stocks that have a real sense of real earnings and leaders in their category, what's called the moat stocks, where they are the stocks that have the best ability to grow and give them dividends and not a lot of risk. So they're more risk averse, and you'll see that as you look at some of these stocks. I want to go back to our just astounding app here, the Momentum Tracker, and just look at the Dow here so you can get some good example here. We have a lot of different canned groups that you can go to in there that you can see, but I want to really focus on the Dow here because that's where the money has been moving, and the Dow only down 8 or 9% now for the year. Is really a small number relative to other things that we're looking at. So let's look at the positive stocks first, and I'm clicking on directional bias here and looking for the stocks that are very bullish, and there we go right there. So there's only one stock that's very bullish, and a lot of stocks that are bullish or slightly bullish in the Dow. Now you can imagine that how the pressure from the market really beat up so many stocks and so many groups, but these stocks that you're looking at here are just exceptionally strong. So Merck, for example, and the other pharmaceuticals did really well. You can see Johnson is bullish. I'm just going to click here on Merck, and I'm going to go to the chart there, and you can see that, our algorithm stayed positive the whole year there in Merck, and it really gave you a very good sense for the bullish conditions that were in Merck. And it's important, if you're an investor, a longer-term trader, to know where those significantly positive or negative conditions are. So Johnson ends the year here bullish, Pfizer slightly bullish, Procter & Gamble slightly bullish, Traveler slightly bullish, Caterpillar, Home Depot, Boeing, Coke, all slightly bullish. Those are the best stocks in the Dow, and you can really tell where the money's been going to. Our cycle analysis, I'm not going to show you that on these, but it was really giving you some sense that a lot of these stocks are setting up much more positive patterns coming into the next year. If you look at our the directional bias right over here, the ratio, you can see in the Dow, 30% of those stocks are bullish, 33% neutral, and 37% are bearish. Which are the ones that are really still bearish coming into the end of the year? Well, you can see Disney, of course, Intel, 3M, Microsoft, very bearish, CRM, very bearish, AXP, very bearish, Apple, very bearish, and then Dow, Verizon, those are still on the bearish side. If you look at Disney, let's just take a peek at the chart there, you'll be able to see that our algorithms kept you negative the entire year with all those ends, different size ends that you're looking at. It goes from very bearish to slightly bearish, back to very bearish, and coming down through the end of the year right there. So you get a good sense. This is really a very valuable app that is for our level 1 to 4 members, and you can also find out the conditions and look at the long term, intermediate term, or short term. If I look at short term, and here you could see that 53% are still negative in there, intermediate term 30%, and the longer term in there 43% are still negative. So it's really filled with information, and you can scroll on each of these long term, intermediate, short term. So great information there, and you can just get a sense for these stocks and these groups and how the conditions are. And right now, coming into the 2023, you have just a tremendous amount of stocks that are in very bad negative, very negative momentum conditions, and some stocks that are really showing up where the money is moving into. And I think that's important information for you to know. Before we get into the analysis of the 2023 market and beyond, I think it's really important this year to share some of the things that I said last year. So I'm going to do a brief replay of some of those for you to see here. Don't scroll forward because this gives a ton of context to what I'm going to show later on in the show in our analysis for the coming year. So we're going to start out by looking at our analysis of the monthly chart in the S&P 500.
That, and again, I want you to note the harmonics in here. We're looking at 20, 40, and 80 months in these harmonics, and this is where the next low comes right over here in the timing range for that low. So that comes out to somewhere between May and July right there. And you'll note that I said that it could go a lot longer, the bear market could go a lot longer into the next decade. And this cycle right over here, the next giant one that you can see right there, takes you way out into 2028. So I'm not saying we're going to have a bear market way out till 2028, but that's where that next dominant cycle bottoms out over there. So that is something that, well, I hope I'm here talking to you about in about 5 or 7 years. So the pattern that we see right now is that this is a period of risk right in here. And the fact that the market is acting so poorly right now on these monthly charts, and you can see these two high waves, this is barely even a downtick when you look at that. I mean, it's just starting right now. And there is devastation in a lot of categories and a lot of different stock sectors. But the indexes have just begun to fall. And those stocks that have been heavyweights in the indexes, well, I showed a chart back in Market Week that said that the strongest stocks historically are the ones that turn into the laggards in the next year. And that's the ones that become the highest cap stocks. And there's just too much money that's in those. And in this case, they are the ones that are the index, heavy weighted in the index stocks. And the indexes are very likely to pull down sharply. The best case right over here that I can make out into this summertime period right there is about 37.53 on the S&P 500. That would only be a 20% bear, and getting down over here to the 25% bear and that 50% fib from this move is a reasonable 3,500 right in there.
So clearly that worked out pretty well, followed our analysis very closely. We got a little help last year as we looked at HYG, the high yield bonds, and that had a cycle analysis that I think was very telling, and I'm going to share with you that brief analysis from last year.
Points to a potential small period of rally here, and yes, another decline here that goes out to July 22 to Feb 23. This is a very important chart, and it really looks like it is failing in here and getting ready to move to the downside significantly in line with these cycles that line up in the S&P 500.
So as the high yields have shown, that can really give us a tip-off as to what the stock market is going to do. And we're going to look at that chart again, looking at this going into 2023. But now what I want you to do is really look at our very significant analysis on the quarterly charts, which has just phenomenal cyclical patterns, and you'll see that right here.
here. And you can see these last several cycles right in here. As we look at present time right over here, here is the great tech bubble. There was a crisis right there, long-term capital, if you remember. Here's the tech bubble and the dot-com bust and the recession. Here's that 7-year cycle. Here's the 7-year cycle. Here's the 7-year cycle right at the bottom. You can see 28 quarters from the Greenspan bubble and the great financial crisis. You can see that. So it was a beautiful cyclical pattern. The next one over here was the mini bear right over there. That was the Bernanke-Yellen bubble. And then this pullback over here, depends on what indexes you were looking at. It was like 17 to 23% decline right in here. And then right over here is Powell's, it's really the Yellen Powell, or Powell COVID-19 debt everything bubble. And the Fed, right over here, you can see that's where they tried to raise rates, where you got that dip. And here is the COVID crisis there. But the cycle bottom was over here. When you look at that way back in 2015. And here, between these two vertical lines, is where the next cycle bottom is. What that says, just as happened right in here, and in here, and in here, that this time frame in here should have the next corrective period in this 7-year average cycle. So it's 28 quarters on average, but the average bear market, the corrective phase, is 4.4 quarters, going back this whole time of the almost 100 years of time that we looked at. 4.4 quarters of decline after the bear market is made. You can see in here these were longer right in here. On these, this was more like about 6 quarters. This one here was almost 2 years, or 2 years right there. This one was only about 2.5 quarters. And right over here, you could see the market is topping. And what's coming up as we look at this is the great COVID-19 reset. So that is an amazing time there that we're pointing at, because it's a time when COVID is flaring up right now, and it'll probably be in much better shape during that period. The Fed is pulling the punch bowl, is essentially what's happening, and the market between the COVID and the Fed and the Biden's whole plan for their BBB, all of that is pulled or stalled at least. That means that the forces that were pushing the market up through the whole time are going to be not there anymore. Now you can see where these levels are in the and the Dow Jones Industrial Average. That way up there, which is a very optimistic level, is 31,720. A 20% bear right over here is 29,200 approximately. That is, in my opinion, an optimistic place to expect the market to stop. So, well, let's just say it's a 20% bear, and that would be 29,150. There's another support there at 28,500 or 600 right at that point. So you can see that that would be a very optimistic area to expect the bear market to end. And this is a very wide area that takes up almost 2 years of time, or a year and a half of time. So the earliest point we have for the low is summer of 22. And it could go way out over here and have a much worse bear market that takes you out into late 23 or 24. So that is very possible based on the timing that we see in here. So, while, we've been talking about a decline, and I'll show you into the summer of 22, that could only be the start of this corrective process that we're talking about in here. And you can see these cycles, they are just amazingly consistent as each of those cycles averaged 7 years, 28 quarters, and we have yet to go into that corrective process.
So that was what we said in the end of 2021 coming into 2022, and you can see the analysis was just really, really good. Now the question is, what can we do for you going forward? Well, before we do that, what I want to do is talk about, if you're new to askSlim, how you could begin to learn the type of work that we do. Our askSlim team is just absolutely amazing, an expert in cyclical analysis and technical analysis, and so many things that you can learn from them for you to be able to do this unique analytical approach. It is our goal not to give you trades. It's just not the business that we're in, like so many other sites. Our goal is to make you the best trader that you can be, and when you put the work in and learn the best ways to really see the markets. And that's what we want to share with you. Level 1 membership is a great way for you to do that. And the level 1 3-month special is just fantastic. It's a great introduction to our services. There's me back down on that corner on the left, looking at charts as I did before I had computers, when I was really heavily into the beginning process of learning cyclical analysis, doing it on paper. I could only do indexes and stocks of about 32, 33 different symbols because I had to put them in manually, and I did that every single Sunday, getting it out of the New York Times, as you could see there. And of course, that silly TV from the 80s there, and that big 100-year chart that's spread out in front of me, and me looking at who's ever taking that picture there and saying, wow, what am I doing here? That was just the beginning of how I learned, and we want you to learn also. If you take a level 1 membership, which is only $45 for 3 months, for $15 a month, you're going to get, I showed you the momentum tracker earlier in the show, over 1,000 symbols and scanning and sorting and 22 different can groups, and we're always adding to that. You'll be able to be getting that with the level 1 membership. You're going to get our stock index report. This is a daily report with all of our technical analysis, charts, indicators on the major indexes. You'll get our weekly Spider ETF review. You'll have our investor trader workbench where you can organize and prioritize and save and track everything, all the work that you do. You'll get our askSlim Market Week show archives. You can go back and watch our archive of the shows that we do and learn from that. And you will be invited to some of the askSlim lives every other Tuesday, and you will get all the replays, 70-minute videos with tons of teaching that we do in there, answering our member questions, and special member videos which are added, which have lots to do with our short-term swing trade planning and many more. And there were just some new ones added to that this week. So please do become a level 1 member. $45 for 3 months for all of this. This is going to be a great start for you to be able to get what we do here at askSlim. So please do become a level 1 member. Any questions, write to Matt at askSlim.com. All right, as we move forward in this special report, big picture analysis, U.S. stock market here on December 30th of 2022, and we're going to begin to look at 2023 and beyond. For those of you that might have scrolled forward from the beginning of the show because you wanted to see what I said about the coming year, you probably missed a lot of context around what we're going to show you right now, because what I started out with was reviewing some things that happened last year and reviewing some of those charts. So I really suggest you go back from the beginning and watch the whole show. For those of you that are here and have watched everything to this point, well, I'm happy you did. Let's start out by looking at the monthly chart on the S&P 500. And I think this will have a lot of great information for you, especially if you're brand new to the analysis that we do. So I'll look at the S&P 500 and then look at the NASDAQ on this monthly chart. So this is going all the way back to 1996. When you see this, and there are cycles on the bottom, and I'll do a little instruction here, which I often do, and that is to show you exactly what cycle analysis looks like. And on the bottom are cycle brackets, and these are simply the energetic movements in the market. There is a natural wave action in the market, and the way that these cycles configure the shape of them and how long they rally and how long they decline, and to the points where they rally and decline, all gives us messages and in multiple time frames. So this cycle right over here, you can see the larger or most dominant one is an 80-month cycle. That's divided into two parts, and that's a 40-month cycle, and then there's the minor cycle right in there, which is 20 months. When they are coming together, that's called nesting, where all of them come together, and those give you the periods where the biggest sell-offs can come because they have rallied for some significant period of time and then they sell off. And you can see in here the 2000 peak of the bull market right there, and then the time period that it fell right to this trough area. And the reason there are 3 stars there because it tells you that there are 3 cycles that are bottoming at the same time. That's what happened here, here, and right over here is coming or has already occurred. You can see the 2000 peak and the bear market to 2002, the 2007 peak and the bear market to 2009. The peak over here, which occurred in 2015 and had this mini bear, it was down 16%. Some indexes were down as much as 21%. And then you have where we are right now. So beautiful cyclical action in here, and these harmonics are 80-month, 40-month, 20-month, and each chart has its own unique cycle lengths, and that's a little bit different than some other cycle analysts teach, but we look for the uniqueness in each chart. Now, what we talked about at the beginning of the show and the beginning of this year, or the end of 21, was that we had expected that the market would decline. And we've said so many times at that time that 2022 would be a bear market year. And that's what we got. You can see in here at the lowest level, the S&P 500 was down 24.4%. Now, our expectation was that the market would decline through this period, and the troughs that as we originally had them, were the potentially occurring in as early as May, and then out to sometime in October, November, and for making the low. Now, being that the market fell towards the later end of that time frame, it then raises the possibility that there will be another decline out over here into March. When I show you the NASDAQ, it looks much clearer because the NASDAQ is actually much weaker. So we had suggested that the market would be declining into this area near 3,500, and sure enough, it got right down to that level, which was really spectacular. And there are momentum conditions in here, and I'll show you that on the NASDAQ also, where our reversal scout turned down, and it told us that the market was weak, and here the reversal scout, though trying to flatten out, is still weak. So the indications that we're getting in the market are still that there is downside risk, and we expect that that could come out into this March time frame. Now, we're in a rally period over here, and we thought that the rally would continue until sometime in around the 3rd week of January, and we've been talking about that as it relates to a low coming in the VIX, implied volatility. So there still could be some rally out here into January, and then we think the risks pick up and there could be another decline. Now, the question is it going to take out that low at around 3,500 and get down to this target level over here at around 3,150, or will it just test that right over there and then begin to move up? It could not test it and that low is in place, and then the projections in here would really not change because they're off of this low, and what they project to is for this year getting up to, in 2023, up to about 4,300. And that timing for that peak, which is in the 3rd to 4th quarter, September, November is the time frame, is in line with what we believe will be the interest rate low. And for big picture in other indexes, that'll be a part 2 for our members only in other markets. So I just want to let you know about that. This is the projection that it will either fall further and then rally back up there. And if it goes further, it probably only gets to about 41.50 if it goes down here first. And if it doesn't make a lower low or just test that low, then our upside target for this year is 4,300. So that would actually be 3,500 to 4,300. That would be what people would call a bull market. But you can see that we think this bull market will not make a higher high. And I have more to say about that when I show you the quarterly charts in just a moment. So that's the picture for the S&P 500. A lower low into the March timeframe or testing the low, and then a rally out into the third to fourth quarter with a peak right now projected at 4,300 in the S&P 500. Now, when I look at the NASDAQ, the picture is a little bit different because it is a lot weaker. And you can see that when we look here at our reversal scout. And this is where it turned negative right there. It confirmed that peak there, which is essentially a double star, evening star, and continued to move down. And it's almost taken out that low already. This projects, which is in alignment with our weekly and also the quarterly, that this trough will come in this March timeframe. So what we're looking for is the likelihood of a little bit of a rally here in January, and then after that moving down again and probably getting down to about 10,000, 10,100 over here in the March timeframe. Assuming that happens, then what we'd be looking for is an upside move, which essentially would be a bull market from around 10,000 to around 13,400. That would be a 34% gain. That's, of course, would be looked at as a bull market, but it would only be halfway back from what it lost in here because these heavyweight techs are just not going to get the traction that they were able to get during this super bubble that was going on right over here. If it got really crazy and went really far to the upside, this level up over here is around 14,200. That would be the best level that we could see. But right now, the projection and what I think is reasonable is that it gets up over here in the somewhere between September to November. That's when we're looking for the peak in 2023, getting up to that 13,400. And then you could see starting to come off again as the S&P does out into 2024. But again, that probably won't make a lower low, and we think that the bull market would continue out over here. I'll talk more about that when we look at the quarterly. So that is a look at the NASDAQ, much weaker. Our projection lower, only getting to this 50% retracement here, coming into the time frame of where we expect the interest rate low to come there. Now, for our level 2, 3, and 4 members, there's going to be a part 2 to this video, and that part 2 will be looking at a lot of the other markets on the monthly charts. So you need to be level 2, 3, or 4 to be able to see that, and that's coming out in a couple of weeks, sometime in January. So that is the special look at this monthly chart of the S&P 500 and the NASDAQ. I'm going to follow up on this and look at the chart of the HYG as I did last year, because that is going to help us with this timing and to confirm that this rally that we're looking for is likely to come. So this is HYG. This is the high yield or junk bonds, and they have very consistent cyclical patterns. And you can actually see here how they follow the S&P 500 pretty closely, because not only is this a factor of yields, but it's a factor of how there is a movement in and out of bonds based on liquidity, corporate bonds. And there was a very, very close bottoming right over here in this gray area is where the nesting is in HYG, and this was the end of 2016, and the market that declined there where it had the mini bear correction. So they moved down together, and you could see the 17-month cyclical action right in here, and the amazing alignment where that was the low, that was the low, that was the low. There was a very weak rally right over here. Now, if you did not watch the beginning of this show, show you missed some context around this, because we had actually projected that this would roll over quickly and then have a downside move. And if you go back to the beginning of the show, if you didn't watch that, you'll see what our projections were from last year, because I reviewed that. So we had expected that there would be a bottoming in here with the S&P 500 and the high yield bonds making their low sometime right over here. And you can see that that really looks like it made the low already. This is actually supportive of the fact that while I think the NASDAQ might make a lower low in March period, that March period may only be a test for the S&P 500 in that 3,500 area. So that's kind of what we're looking for. Now, again, the rally that we're looking for goes out here into October. And again, we expect that the stock market to be in lockstep with the high yield bonds. And that would, the reason we point out to October is because that's the time frame where the bigger picture of yields point to that, to making an important low. And that is giving us some sense that the bond market will rally into this time frame, that these high yield corporates will rally at that time, and that would be supportive to the stock market. Just as the analysis over here was suggestive that there would be big declines into this period here, and this actually went deeper than we had expected it to, it is now supportive to the stock market, and we are looking for this rally over here to the midpoint right there, which would take you to about 79 in HYG. So we think that is important analysis to the overall stock market, which we also looked at last year. All of that pointing to a rise for corporate bonds and a rise for the stock market into that period we're looking for in September to November of 2023. So there are much bigger cycles in the markets. And I'm going to show you some of those and some eerie comparisons. I think really very important to look at, because we're going to look at very long-term periods where the market had really excessive rallies, and then what it actually took to correct those markets. And I think that's really what you're going to find as a scary comparison. So let's take a look here as we switch over, and we're going to look at a period of a long upside rally, starting from the bank crisis in 1907 all the way through 1929 peak right there. So this is a 22-year period right over here where the market had a huge rally. Huge, I would say, maybe an understatement, 633% that the market moved up during that period. It was certainly excessive. And you can see that after the banking crisis in 1907, then we got into World War I there, and the market actually closed down for a little while, and then it began to trade to the upside again. And here, right over here in 1921, and you can read the book by James Grant on this, was the Forgotten Depression. And he makes a point that the government was very hands-off at that period, and then that gave the market a chance to heal itself, the economy a chance to heal itself, and then things got better after that. But then we had the Florida land bust here, and the Fed began to act in ways that was very stimulative. We went into the roaring 20s, and you can see what happened is you had this final huge acceleration right up over here for that big gain of 633%. So that is significant when we look at that. Now, what I want you to see in here is the look at the market as we look at the comparative period here. And I'm just going to move this chart up for you to see the chart that compares to the period we're in right now. This is pretty amazing. If you look back here to the .com bust right over there, and then this rally, well, this was 20 years and pretty close. The upside, the last phase, of course, there was a super excessive phase to the upside after the pandemic and the massive stimulus there, and 413% gain off of the .com bust low right over there. Of course, we had the very great financial crisis right in the middle, and this massive period here of the government spending just sick amounts of money, the Fed's zero interest rate policy, and massive speculation in crypto, NFTs, SPACs, and stock market valuation got up to about almost 200. Actually, the market cap to GDP right over here was 196%. Compare that to the time of the Roaring Twenties. The market cap to GDP was about 118%. So the amount of excessive movement in there was much greater than in the time before the Great Depression. Now, of course, what happened after that move in 1929 was a very significant corrective period there. The market, the economy suffered from the price manipulation that the government had done, a Fed policy error of contracting the money supply and then trying QE in 33, and they bailed on it in 36, and the social programs in the New Deal, which just simply did nothing but to extend out the Great Depression. Of course, when the war came, things did change, but this was 13 years really to correct the over stimulation that went right there, and that you got to wonder about how that looks in our future. I'm going to look at a quarterly chart and show you that. I want to look at one more time frame in here, and that is where we're looking at a similar occurrence right here, and that is the period that occurred from the that began the post-war boom right over here in the low of 1949. This rally in here was 20 years, 1949 to 1969. Pretty similar when you see that. It made kind of a double top over here. The market cap to GDP, get this, was only 0.82. And then we went into a massive correction of that. It just that it was a 20 years of massive bull market that needed to be corrected. And of course, what happened after that was the great inflation, which came from 1965 to 1980 when Volcker began to put the cure in. So 20 years of a massive bull market where the market moved up 525%, only up to a 0.82% market cap to GDP. It was so much cheaper compared to where we are at the peak here at 196%. And what did the market do after that? Well, this is essentially a lost decade for investors, as 13 years it took to correct that. What happened in here in that 13 years? One bull market, two bull markets, three bull markets, one bear, two bears, and three bears. And that is, I think, important to see, that when you get these long bull markets, that there is a long period of correction. And when I show you the quarterly chart in here, I'm going to show you how that projects out for right now. So you can see right there, looking at that period, how similar it was, and the amounts of gains in that 20-year period, and then this period of long correction. This was 13 years. We showed the period after the Great Depression to be a little bit shorter than this, but still it takes a lot to correct the huge excesses in a market. And when you look at this bottom chart here and you look at a GDP that got up to 196% market cap to GDP, you know that the excess that we have had has been historic. And the amount of correction that it's going to take is a lot more than we have seen so far. As a matter of fact, it might take a whole decade or longer to correct that. And I'm going to take a lot of heat for saying that. And that's why I wanted you to see historically how these long rallies bring these long corrective periods in here, and how what usually happens is that stock market investors become very disillusioned for a long period of time. And you can see in here multiple bull markets and bear markets while it corrected a 525-point gain. And that lasted all the way from this peak over here in 1968 all the way to the low, important low that was made here in 1982. Even if you say that the correction was from this time period over here of 66 to 75 low, you still have 9 years in there, depending on how you measure it. So that really shows you that there is likely a long correction coming ahead to correct the excesses, wow, of the bull market that we have been in. I'm going to switch over and look at the quarterly chart now and show you what that projection looks like. Again, I want to encourage you, if you did not watch the whole show, there's a lot of context about what I'm going to show you right now, the quarterly chart, as I reviewed the projections and movement for 2022. So go back and watch that if you have not. Here is the quarterly chart, and this chart goes all the way back to the period of 100 years ago, essentially, with a beautiful rhythmic motion that you can see in there. And look at the cycle low that occurred right over here and the cycle low that occurred right over here. Those are almost exactly 7 years apart. We're looking at a 28-year quarter. This is the decline of this cycle here, which is the dot-com bust, the great financial crisis, the mini bear here in 2016. This COVID crisis here actually occurred in the middle of this cycle, and then it extended up in here as the everything bubble occurred and the market cap to GDP gets up close to 200%. And we had projected that this cycle over here was coming down and aligning with the monthly cycles, and that there would be a down year this year. So what I showed just a few minutes ago, looking at the monthly charts, was that there are periods where there are long rallies in the market, and they last 20, 22 years, and there are long corrections after that. And those corrections tend to last somewhere between 9 and 13 years after excesses on the upside. And this is the greatest excess we have ever seen as the valuations got to historic levels. And even now at the end of the year, the market cap to GDP, which has come down quite a bit, is at about 153%. Now, historically, that would bring a crash. I mean, that is what's excessively high, even though we have had a bear market this year. So if you project out the next cycle, and assuming this one is bottoming in here, what is exactly likely to happen? So we're projecting out, well, all the way out to the end of the decade, into 2030, and this would only be a 7-year correction in here. So going back to what we said, everything in the beginning and throughout this show is that the Dow Jones Industrial Average is stronger. Here you can see it's only down about 8% on the year, as it had this big rally back here in December, while the other indexes have not done that. So our projection for the year is that the stock market would continue to gyrate early in the year and then move up in towards the end of the year. That should bring the Dow Jones Industrial Average to a new all-time high, probably this year. That might be a pretty bold call, but while that would be a bull market and other indexes would follow, the S&P 500 is not likely to make a new high. And if I had the NASDAQ in here, it would be even lower. We think that the broad market will not make a new high this year, and that sometime out over here, a couple of years from now, you might even get higher highs. But we think overall, this is going to be a large corrective period, like you saw from 1929 to 1942, or you saw from 1966 all the way out to 1982, 1968, depending on where you look at that peak. And this could actually be just 7 years, and then another big cycle after that is more correction. We think that this big everything bubble here and the damage that the Fed and the government spending has done, it has a lot of time to go to correct. Yes, we're looking for a bull market move, an upside market, and an up market for the year in 2023. We just don't think it's going to amount to a huge bull market that goes anywhere to all-time highs, except for the Dow, which is attracting a lot of money because investors want to be where they think it is safer. Those moat stocks, the stocks that are the top in their sector, the stocks that have the highest dividends and well capitalized. That is really what they're moving into, and that's why you see this big move in the Dow here. The Dow is very likely to go to an all-time high, while the S&P 500 and the NASDAQ and the Russell do not and languish. And overall, we're looking at a very, very long period. Because look here on the bottom, and you can see this great activist Fed right in here that went through all of this long period of zero interest rate policy and even adopting MMT through right here, which is, I think, total insanity. All of that is going to take a long time to correct. Many, many years. Bull markets will be there. I think there are probably going to be several like we saw in the 1970s. But overall, I think we're going to get into a period of investors being disillusioned for a long time. That is the look at the quarterly chart and what I think is going to be a good year for 23 overall, and overall for the next decade, potentially a big, big, wide period of correction and very wide chop, and some bear markets that are going to get investors really unhappy. So on that mixed message, the good news is there's probably amazing trading markets ahead. And of course, it's not only the stock market, many markets will offer many opportunities. And part 2 of this special report will be coming out sometime in January, where I'm going to look at the monthly charts in a lot of other markets, bond market and bond yields, the dollar, euro currency, gold, silver, platinum, copper, the oil market, and natural gas. All of those have really nice monthly cyclical patterns, and that will be available for our level 2, 3, and 4 members. That will not be on YouTube. At least for probably at least the first 30 days. So you're going to want to become a level 2, 3, or 4 member to watch that. So here at the end of 2022, there is actually a lot of negativity out there. Market's getting sold hard and beginning to start to look like it can rebound here after all the tax selling. And when you look at what's going on as far as the put-call ratio here at the end of 22, the traders, investors are buying puts like they think they're going to run out of them. Put-call ratio has moved to historic levels. Also, I wanted to get a feel as I was doing this show about what some of my followers and viewers thought about the market coming forward. So I put up this poll on YouTube, and you can see that there were 651 votes that came on that. And I asked year-end poll for the stock market. And at askSlim, we're preparing for our year-end special video in which we project the stock market for the following year. And please vote. And that would be the bear low is in, and a bull market ahead for 2023 to all-time highs, and 10% said that was the case. The bear market low is in, but the bull market will come in 23, but no all-time high, and about 7% thought that was the case, that it wouldn't go lower, but it also won't make an all-time high. The bear market continues in early 23 and then choppy, maybe a 20+% rebound, and about 49% thought about that was the case. And of course, that's in alignment with what I have presented here. And about 34% said a steep bear market continues for most of 23. Bull attempts fail. So 34% thought that it would be just basically a bear market year following. And overall, it is a total of about 83% that had a real bearish bent in here. And that gives you an idea as to the amount of negativity in here. So I think that was an interesting poll as we get here into the end of the year. The some of the evidence really as I sum up this long video here is that it will be, in my opinion, based on all of the alignments, a positive year in 2023. Now, it probably will start out with a challenging early period and maybe first quarter. And then after that, I think it's going to be better. Overall, I think that the period following that, as I showed you in the long bull markets that were followed by long corrective periods, that there are a lot of challenges ahead, all the way through the end of this decade and maybe beyond that. There is a long correction very likely to come, and the opportunity for the market to make significant new highs. I don't know. I don't even know if that's in my lifetime, because they've already spoiled the market with the incredible high valuations that they brought it to. And the Fed and the government stimulus and all of that period is really gone. And we're not going to see zero interest rate policy again. We're not going to see the Fed build its balance sheet that way again. And when we see the time when the Fed does have a pivot, that probably is going to come with very minor moves to the downside in the interest rates because they're not going to want to get into this problem again. So we're looking for a long period in the future where the Fed and the government will not create the kind of support that they did. And I think that that really sets up what I think is going to be that long period of correction out there. And again, I think a pretty good market. Here's what those poll members thought. Basically bearish, put call ratio very high, and probably going to get a rally into January, and then that weaker period out into March. I want to remind you, please become an askSlim Level 1 member. If you've never been a member, this is a great way to understand the things that we're doing. You'll get our Slimulator momentum tracker, which I demonstrated earlier in the show, stock index report daily with all our technical analysis, charts, indicators, major indexes that we look at, the Spider ETF review weekly, our workbench with a lot of ways that you can organize and prioritize and save your analysis, askSlim Market Week show archive, and just you're going to be able to review all of the analysis that we present every week. You'll be included in some of our live shows that we do, and the replays from that, you'll get them all. Good 70-minute shows with tons of analysis and questions from our members, and our special member videos, which we just added some. All of that just $45 for 3 months. How can you not do it? That's just amazing. So I want you to, right now, if you haven't been a member of askSlim, now is the time to take advantage of this. Go to askSlim.com, learn everything you can there, follow, share. If you're new, you can even get a free membership, but you're not going to get everything you get in Level 1. On YouTube, subscribe to our channel, click that notification bell, and like this video, give it a thumbs up, and watch our member videos in the playlist and past shows. On Twitter, follow us at askSlim, and any questions that you might have, write to Matt at askSlim.com. I want you to be so incredibly careful. It is so crazy out there, and I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been